Good afternoon, everyone. I'd like to thank each and every one of you for who are joining us this afternoon for the technical session, for our third technical session in track 1, titled Harmonized Regulatory Framework for Microfinance Lenders and How Will It Help Us Servicing the Poor? It is my pleasure to invite the esteemed panel for the session. The session is co-curated in partnership with Sadhan. This session shall be moderated by Manoj Sharma, Director, Microsave, and the panelists include Veena Srivastava, General Manager, Reserve Bank of India, Munish Sharda, Group Executive and Head Bharat Banking, Axis Bank, Dibya Jyoti Patnaik, Director, Annapurna Microfinance, and Bhaskar Babu Ramachandran, CEO, Suryodaya SFB. Thank you everyone for being a part of this panel. Manoj sir, I'll open the floor up to you.
Thank you, Anusha, and once again, a very warm welcome to all the panelists. It's a very interesting session, and I really look forward to the next hour plus as we discuss the changes in regulation that are on the horizon, and that RBI has sort of proactively taken up. That it's about time for a change in regulations. I'd also like to welcome all in the audience, and I would like to encourage you to ask questions. We have a very distinguished panel representing Small Finance Bank, NBFC MFIs, banks, and of course the regulator. So this is what you could probably ask for. I mean, this is what really constitutes the sector. So we have the entire sector represented in some senses. So once you go through the consultative paper that RBI has released, there is this preamble which says that the microfinance sector started in the 1990s, and then there were repeated attempts to get the RBI to regulate the sector, and it quotes instances in 2001, 2005, where attempts were made to get RBI to regulate the sector. I happen to be a mid to junior level officer in the Small Industries Development Bank of India those days, and somebody who has taken over as what we used to call Grade C those days in 1999. And my boss's boss used to be Mr. Bridgemohan, who in some senses we all call as the founder of the MFI sector. And he was very keen that RBI takes the mantle, and he would say कि Manoj, जब तक RBI नहीं लेगा, sector formalized नहीं होगा. Sector will not get formalized till RBI sort of steps in. And we used to see him making trips to RBI every now and then, trying to convince the RBI that the sector is big enough and that you need to regulate it. And every time he would come back, and you could see from his face कि भाई सुनवाई नहीं हुई. He would come back and say यार सुनवाई हुई नहीं. And they still feel that we are very small, and that this sector is not something that they would like to regulate. Of course, RBI's regulatory bandwidth is most of the time is so stressed, with the cooperative sector giving its fair share of hassles, that RBI those days used to think that bhai itna chota sa sector, and it was such a diverse sector. All sorts of players were there when we started off. It started off in 1990s, but actually started picking up steam towards the end of the 1990s, more towards the early 2000s. And that's when, of course, the now infamous, famous AP crisis happened, and RBI then decided that this is maybe not in terms of outstanding, because the logic that was always handed out was you are not even 1% of the total assets that have been created in the banking sector. So, why should the RBI get worried about what is such a small quantity? But from that time, and one has to give credit to the Reserve Bank for having stepped in to regulate the sector, because once the RBI starts regulating, it brings in a lot of formal finance into the sector. Not to say that before this formal finance wasn't there. India is one of the few blessed markets in that sense, and SIDBI was one such forward-looking agency that allowed formal finance to step in. The whole priority sector lending meant that the taps were always open, and that we never had a situation where the sector was starved of funding. But even then, in today's terms, if I were to look at this consultative paper itself from RBI, and we are talking September 2020 numbers, we are saying that more than $30 billion USD is outstanding from the sector, which is 2,27,000 plus crores. And this number would have gone up in the last 1 year, given that lending is happening at a brisk pace. We are talking about 10.3 crore borrowers. if these were to be unique borrowers, we would have been talking about almost 50 crore people in India, yeah, which is almost 40% of the Indian population is covered by this sector. Even if we take that, this number is half, we are still talking about 20-25 crore people are touched by this sector. No other sector, no matter what the outstanding numbers look like, quite impacts so many households at a level of the sort of impact that microfinance sector creates. So I think in that sense, the AP crisis was about watershed moment. It brought in this whole, the Malegaon committee, which came up with its own 6 or 7 pillars on which they based the entire recommendations. And one of this, the very positive thing that came out was that a category of NBFC MFIs was created. Then, of course, microfinance loans, the whole qualifying asset principle was brought in. Nothing, again, we didn't see any other parallel very clearly in any other sector. So all of this was very innovative. And even after, subsequently, whenever I visited Bangladesh, there was a lot of curiosity within Bangladesh Bank that what is underlying all the recommendations that have come in and the regulatory guidelines that have been made. And RBI is looked upon, at least in South Asia, I can say that RBI is looked upon as a trailblazer. So whatever RBI does is looked at very intently by regulators in Bangladesh, Nepal, and all of these countries. Then, of course, we had the prudential norms, capital adequacy, provisioning. But the most interesting was on the pricing of credit, where this 10-12% margins over the cost of funds and so on was brought in. Again, something very different, very, in fact, very divergent from the RBI ethos and thinking till that point in time that, we will not put caps on interest rates and it's a free float world and we will allow it. So I think a lot of regulatory churn thinking would have gone in at RBI at that time that do we need to change for this sector, and change they did, because in no other field I can think of where such sort of very fine regulatory guidelines were prescribed that, this is what needs to be done. And then, of course, multiple lendings, how many loans can be given to one borrower and so on. From there, the sector has changed so much, as the RBI paper, again, if I were to refer to, says that, we are talking about a sector where only 30% of the market is now controlled by the NBFC MFIs, which are the regulated entities. And here again, one has to keep in mind that probably for the first time, the RBI decided to regulate a lending channel, a type of an institutional type, rather than a sector. Yeah. So I think some of those corrections, and of course, none of us could have foreseen that bank lending to this segment would go up the way it has gone up. The sort of acquisitions that have happened, and then of course RBI came up with the small finance banking license, and a lot of NBFC MFIs were given the opportunity to become banking entities. So I think all those changes happened, and today the consultative paper talks about household level income. So it is started looking at, instead of the individual, it started looking at the household, and then there's definition of those households, and it's saying that as long as the lending is capped to a level where the repayment of principal and interest and so on doesn't impinge more than half the household income, it should be fine. And it acknowledges that maybe to some extent the cap on interest rates and so on meant that everybody thought that this is the RBI approved rates and we can pretty much charge up to that. So I think there is a acknowledgement that maybe this led to it, and we have no intention of this or doing this, and we would like market forces to play the role that we would like them to play. So I think with this background, I will sort of move to the panel. I think they will have far more interesting anecdote stories and also concrete sort of thoughts and actions for to share with the audience here. And first move to Mrs. Veena Srivastava, General Manager, Reserve Bank of India. And ma'am, like to ask from you that given the consultative document, the proposed set of guidelines on the regulation of the microfinance sector, it's a fairly forward-looking piece. Again, it's one of its kind piece in the entire sort of sector globally. And while the debate will keep going on, just as we debated when the first set of guidelines came in, the debates will keep going on. What is good and what we perceive as not good, and we'll have very different views. I mean, the sector also has different views, and I'm sure you would have heard all of them. Tell us a little bit about the process that was adopted in getting to this document, and also what is the current thinking within RBI in terms of the microfinance sector, the regulations. Of course, we don't want you to let the cat out of the bag. I'm sure you will not. You are a seasoned central banker. But just an overview that you think you can share with the sector would be very useful, ma'am. So over to you.
Yeah, thank you, Manoj. Good afternoon, everyone. So first, let me thank Inclusive Finance India team for inviting us for this panel discussion, which seems to be very lively. At least the way Manoj has given the background, and some of the things was like, to be very frank, it was not known to me prior to its the entry of MFI as a regulated entity of RBI. So really it is interesting. But that interesting in a story you should not expect from the regulator, because regulation is always very dry. So as Manoj has said, that the document, this consultative document which we have came out in June this year, and we have taken the feedback. So most of you might have at least seen it. So as you know, the current regulatory framework, which was put in place with the objective of making credit available to low-income households and to protect the borrowers from harsh recovery practices of the lenders. So we came out with a specific guidelines which was applicable to the NBFC MFIs only. Even till now, it is applicable to NBFCs and MFIs only. But what we realized, that other lenders, which now form a share of around 70% in the microfinance portfolio, are not subjected to similar regulations. They are also regulated entities. But as you know, this MFI guidelines are very specific guidelines and specific to this sector, these entities. So this has created a non-level playing field, posing difficulties for customers, as well as it resulted in emergence of different practices within the sector. So we felt that the regulation should focus on the repayment capacity of the borrower rather than considering only indebtedness or indebtedness only from the NBFC MFIs in isolation. So that is why we propose to address the issue of over-indebtedness by prescribing a common definition of microfinance, which will be uniformly applicable to all the regulated entities or the entities in this segment, and linking loan amount to the household income. So household income is not very new to this segment, because earlier also the identification criteria was the family income. And that is why we used to, microfinance borrower used to be identified, but loan amount was not linked to those incomes. So this is one big change we had proposed in our consultative document. And of course, this is a sea change. So we have received a good number of feedback, and market is looking at it like how they have given a lot of inputs, like how they are looking at it. Further, when you look at our consultative document, we have indicated our concerns. The foremost is the over-indebtedness of the microfinance borrower, and which ultimately results in the default and coercive recovery practices followed by the lenders. And this segment is slightly ultra sensitive. That is what I will say. And this Second aspect is compromise with the basic principles of responsible lending, such as the assessment of borrowers' repayment capacity. Respectful behavior with the lenders were expected to adhere by them. And thirdly, this which has been discussed in detail, that emerging dynamics in the microfinance sector and related concerns around customer protection. So if you see, like since the beginning in 2011, when RBI started the regulation of MFIs, two aspects were means not just primary, but it was foremost important, like that is the customer protection and over indebtedness of the microfinance borrowers. So regarding when you say what is our view and what is the thinking going on in RBI, you see this microfinance is basically a very important tool, rather most important tool to foster financial inclusion, because the target group is such which is very like a vulnerable group. While serving the underprivileged, microfinance also presents an opportunity for expanding the benefit of financial development to these segments, which we call bottom of the pyramid. And like if you are following this sector, you would have read the speech given by our DG, Shri M. Rajeshwar Rao, who have said that, who has quoted that, and I'm quoting him verbatim, that we would like to foster the growth of the sector guided by the ultimate objective of financial inclusion and customer protection while providing a level playing field. It very well summarizes the current thinking, as well as, I don't say that it is the current, that is the thinking which has remained even in 2011, and it continues to be our thinking for the microfinance sector. With this, I'll hand it over to Manoj.
Thank you, ma'am. Very, very interesting. And I mean, probably the right focal areas, I mean, in terms of, because over-indebtedness is definitely something that worries all of us. And we always worry that if too much lending is downloaded on this segment, what is going to happen? And during the AP crisis as well, the government always takes a view that, because at one stage in the AP crisis, we were all thinking, why is the state government intervening? There is RBI, there are institutions, there are people. RBI will look at it. And the then principal secretary, when we met him, or SIDBI met him, said that, you guys think that the poor do not have a custodian, and the government is the custodian of the poor. We will always step in when we feel that the poor are being shortchanged. So I think for us, the good thing is that after that, there hasn't been an instance where a government has stepped in at this scale. Yeah. And I think, or, let's leave Assam aside for the moment. But by and large, we have managed over the last 11 years avoid such an instance where, other than RBI, another entity, another regulatory body, government steps in and says, we will now do this or we will do that. And I think for us, that is the big thing, that even as the sector has grown, we have managed, or RBI has managed to keep it on the rails and not to come flying off the rails. So there's too much at stake. But with that, I'll move on to Mr. Munish Sharda, the head of Bharat Banking, Axis Bank. And I'd like to ask you, Mr. Sharda, as to what do you think as a banking, as a banker, about the new guidelines, and how will it impact the microfinance portfolio of banks? So that is one. And then what change in strategy, if any, the bank is thinking through, that you will have to implement it as and when these regulations were to be formalized, or the RBI decides to come out with these regulations. So over to you.
First of all, thank you, Manoj, for having me here on this very important topic for the microfinance industry. A very good afternoon to all the respected participants and the fellow panelists on this conference. Madam Veena, thank you for enlightening us on the RBI's view on this matter. While these are still the draft guidelines, and I do not know how the final guidelines will finally shape up and what the regulations would look like, but I will share my thoughts on what I think about this about the paper, and how I think that banks in general would need to look at the entire regulation and what it could lead to eventually, both for the institutions as well as for the country, for the microfinance borrowers. Now, to my mind, I think the most important thing that one must keep in mind is the borrower in this case, especially when the borrowers are vulnerable. It becomes extremely important for the institutions and the intermediaries, etc., to ensure that we keep the borrowers' well-being in mind. And to that extent, it becomes important that the responsibility of the borrower's well-being is kind of owned by the institutions and possibly by regulation, etc., which are meant to protect the interest of the borrowers. We've seen the industry for a long period of time, and I have had the benefit of now seeing it from two sides. One is from the banking side, and second is from the insurance side, since I also used to run an insurance company in my previous role, and I've seen microfinance for a long period of time. What I'm particularly excited about these regulations is that, one, it creates a level playing field for everybody. Second, I think there is this entire thing about bringing enormous amount of transparency in the borrowing process. I think that's very, very important. That one sheet that is mentioned in the regulations about clearly delineating the various components of the repayment schedule and the interest rate charge, etc., will bring a lot of transparency to the entire process. And it is our duty as lenders to ensure that we clearly tell the borrowers as to what would it entail, because it would eventually end up bringing more discipline into the entire industry in terms of the entire borrowing process, etc. And in the industry, to that extent, will move into a better zone both from a risk standpoint as well as from the performance of the borrower's standpoint, because an informed decision, in a decision which is made in a more informed manner, is likely to be sustained better than a decision which is led largely by some misinformation or some other way in which the borrower is not fully informed. So transparency, as envisaged in the new regulations, I think is a positive step. Personally, I believe in it, and I think this set of borrowers deserve this from their lenders, and I think it's very, very important. The second thing is this on household income. The entire you've asked me this question about Manoj, about how will banks look at it, and how do you expand the portfolio, how do you do more with these borrowers, etc. One of the issues that is there is that any non-standardized way of acting in the marketplace can lead to outcomes which are distorted, and which also lead to a lack of deep understanding about what's likely to happen and what's happening on the ground, which prevents sometimes the institutions to keep away from going and taking that extra bit of risk, or testing some new things, or piloting some new things, etc. And that kind of also impacts the entire lending and borrowing decision. I think this move towards making the entire borrowing lender agnostic, in the sense, and that I will look at the household income and look at the overall indebtedness, brings some degree of certainty into the entire lending process. You know who you're dealing with, the norms, as long as they're followed by everybody and that people don't violate those norms, it brings certain degree of certainty into the entire lending process. And that then allows also to make some extra decisions or better decisions in terms of doing more with the same borrower as the behavior matures, as doing more individual lending to these borrowers, etc. I think that becomes much better. The third thing is that this entire thing around collecting more data, doing income assessment, having some broad guidelines on it, etc. I think that will also play a very important role, Manoj, because as you collect, today we are living in a data kind of an economy, and as long as more and more data keeps becoming available for any single transaction or any borrower, etc., the ability to take better risks keep on improving with more data points, etc. Right? So, and you could correlate it better with various aspects of the lending, the borrower type, the income stream, where the money is being used for. and all of that stuff. So that makes it better. Fourth point is, I think this entire suggestion, the regulation around not lending for, I'm also thinking of the borrowing community here, not this taking away the limit of 50% for income generation activities. Well, of course, that's a very important objective to help the borrowers in doing income generation activities. But it is also very important that the loan actually ends up protecting the borrower from some usurious local lender-based lending, etc. I think that is also a very positive step. Lastly, for me, I think on the pricing bit, it's a lot has been talked about the pricing and the limit, and it ends up becoming some kind of a norm, etc. I think the market forces have to define the way the players engage in a marketplace in terms of pricing, etc. And as a result of it, the borrower eventually benefits. I think the models will evolve over a period of time to find the right borrower, to find the right segment of customers, to do more with the existing customer, to lower your cost of operation, use more technology, use more data in your lending process, so that you are ending up making the business model profitable. Because remember, if the institution is not making money, having a low lending rate or high lending rate in isolation, it cannot be seen in isolation. It has to be seen with respect to the entire business model that you are operating. And if the competition comes in and it kind of drives you to improve your efficiency, you do more using technology, do more with the existing borrower, use data better, use some other credit models, etc., that would eventually end up, being beneficial for the customer. Any competition or any move which induces more competition into any segment of the industry or any market, etc., is always beneficial for the customer in the long run. And anything which is beneficial for the customer in the long run has to be beneficial for the industry and the participants in the long run. Because something which is not beneficial for the customer in the first place cannot benefit the industry for a long period of time, right? Yes, so those are my thoughts.
Yeah, those are excellent thoughts. I mean, I completely agree on the data. I think we're sitting on lots of data, but I don't think any institution really does anything with the data. So I think that's a very good point, that if we start taking the data, analyzing it on a household basis, there is opportunity for cross sales. I mean, for all the institutions, especially the banks, of course.
Manoj, I must tell you, I was sitting with some borrowers in South India, and I was talking, and I'm also worried about, we are talking of borrowing on a standalone basis does not really mean that you're not saving. You're borrowing, and somewhere you also keeping some money, you keep saving, right? And that's why your borrowing gives you a leeway to repay back over a longer period of time. I think there also exists a large opportunity in these markets to create some micro saving and micro insurance products for this set of customers based on this data. But I think that's something that can also be worked on. And today, using technology affords you the capability of really customizing thing to the last link, to as many customers as possible. So those are also the possibilities which can eventually end up enhancing your income stream for the same set of borrowers, which really work for the borrowers in that sense.
No, absolutely. I think this is a very good point. Another good point, that, product innovation had been stifled. Everybody came together, that same amount had to be given. The next cycle also probably would be similar. Now the RBI is saying, do pretty much what you want, get us, your board to approve what you're doing, and maintain transparency. And we will see you. We will then look at you from those days. And a very interesting point on this whole debate around productive loans and non-productive loans. We used to write quite a lot from MicroSave, saying that, the moment you are saying that it will be for productive loans, you are starting off the relationship with a lie. Because when you go and the borrower knows that it will be given for productive purpose, there's no way of finding out whether that buffalo was actually bought from the loan or was there earlier. And the other thing, an anecdote I like to share, is that once during a market research, we talked to a very old woman actually, and her granddaughter was being sent to school, and she had taken a loan. She was taking a loan from microfinance institutions, and of course, part of it was going towards the school fees. And we asked her, "School kyun bhejte hain? Why are you sending this girl to school?" Hoping to hear in the usual cliches कि अरे लड़के और लड़के लड़कियां बराबर हैं, no, girls and boys are same, or some such thing which we are so used to. And she turned around and immediately said, इसको पढ़ा देंगे, दहेज कम देना पड़ेगा. If I'm going to teach her, I'll pay less dowry for her. It was so clear in her head where this money was going and what is the return it will get her. We were all sort of, we didn't know what the next question we should ask. So trying to put poor people in a bucket where we feel that they don't understand. So that's where we always say that, financial literacy is not about teaching them finance. They know more about finance than we do. What it means is that teaching our ways of finance, which is, this is a savings product, you need to go and do this and fill that form. And so it is all about a process that we frankly have created. Yeah. Don't try and teach her about finance. She knows a lot more, I can assure you, than any one of us does. But with that, I'll move to Dibijyoti Babu, running one of the very large MFIs, very stupendous growth of course, headquartered in Orissa, but a very good name that Annapurna has created over the years. And of course, he's been the driving force. Similar questions to you, Dibijyoti. How do you look at it? I know that the microfinance sector has been clamoring for a long time that banks and SFBs are getting away and all the regulations are meant only for them. So I'd like to hear from you, what you think about the current regulations and, how will standalone institutions, especially the NBFC MFI industry, how will it stand to benefit, lose, gain from the proposed regulations? So over to you.
Thank you, Manoj. Thank you for your kind words. And thank you, all the organizers of Inclusive India Summit for inviting me for this talk, and all the viewers, listeners, and all my panelists, co-panelists. Thank you very much for being accommodative. Manoj, you have put in the right question. We've been definitely complaining about this to the regulator that, it's not a very level playing field, for us, that all the regulations are applied to us, not to them. And, that's what is creating a lot of problem in the field. And there should be a new regulation. We should look at a new regulation, being it's already 10, 11 years of the regulation that has come post Malegaon committee. So definitely it's a welcome move. A lot of the things that the industry was asking for is already there. But if you see from the regulator's point of view, like the Mebina ma'am said, and all the guideline that is there, it is more focused towards the client, which is more focused towards the client protection, more towards over-indebtedness, more towards multiple lending and pricing, so that the expectations from the regulator is that the pricing should go down with the but what the regulation doesn't change is a standalone regulation for entire country. When I belongs to a state of Odisha, which is one of the poorest state, and the same Annapurna also works in Punjab or Tamil Nadu, where the GDP contribution to the national contribution is almost 3 times, 4 times, or the below poverty. The income levels are very, very different. Now, if you start, the most important aspect was, when the last regulation came in, we said that it has no scope for any innovation, because the entire product was actually prescribed by the regulator that this is the product, you go and deliver. And that has been the case since then. We were expecting that there will be little more headroom here to innovate some of the products, being the change or the requirement of the clients are changing. And of course, the requirement from the client are different at different part. For example, we ourselves from the industry, being from MP and Sadhan, we have brought in different criteria at different state level, in order to bring down, because we also understand that we are working with a very sensitive set of people, and this could trigger problems. It has triggered problem. We managed sometime with the help of regulators, sometimes with the help of local, government machineries that understand the the importance of the sector. Somehow we managed it, and we all ourselves are very, very careful of not stepping out of the boundaries that are put in for us. Even some places, some states, we have brought in further boundaries for ourselves, to minimize, because that was the case, because the regulation was applicable to the entire country, and we were hoping that there would be some more flexibility in terms of how you design it, depending on what kind of the state. Second one is again the challenge that we see from the industry is that while most of them are actually very, very welcome step, whether it is the deregulating the pricing or bringing everybody into the same regulatory framework that are working in the same sector, lending to a particular income segment of people, which is a very good and very substantial move from the regulator if that happens. But again, qualifying the household income, the household itself, the definition defining the household itself, there are a lot of things which are going to be tricky and challenging. And I think we need to have some amount of clarity in those areas, like how do we reach out to those, because then people will start calculating at a different level. And third is that if you crop the EMI, the outflow of the payments from the income, then eventually we are talking about a particular loan, because if my income are fixed to a level, and then I'm talking about say 50%, then I'm other way around actually clubbing the amount of loan that can be given to a person, irrespective of whatever the cash flow and other things are. And it might get into again a standardized product that this is the cash flow and this is how much I have to pay, and so you end up back calculating a 5,000 EMI and hand over into a 60,000. So that's which should not be the case, because we should evolve from here. The industry has grown, and as you said correctly, that the clients are much mature before 10 years before they were, so they can take their decisions. They can take different decisions making, and we can brought in a different products which is more flexible, longer tenures, which need robust underwriting processes to be in place, because these are unsecured loans. So I think that those are the challenges the industry is going to face going forward once this will start implementing. As far as the transparency is concerned, what Munish was trying to address that the regulation is very much into it, which is already there for the microfinance industry. We have already prescribed by the regulator how do we calculate, how do we communicate our rate of interest and everything. It is very, very clear what we can charge, what we cannot charge is already defined in the earlier regulation, which is the new guideline is little more in depth to that, where some additional, insurance cost and other now need to be captured. But it was there, by and large, it was there in terms of the transparency of the cost is concerned. For microfinance industry, it was, probably not there for the other players which are, active in this space. And third and most important, as you know, that, in the growing space, 70-80% of the market is already captured by or is moving towards bank, small finance bank, more, for a pure play microfinance institution to survive and to continue to serve to the clientele. It is very essential that it has some flexibility in terms of the product design, and because anyway, any given time, their underwriting ability vis-a-vis a large balance sheet of a bank would be much lesser. So there should be some flexibility, I think, around that. We have represented from the industry to the Reserve Bank, and also the fact that, because there is a 85% and 15% cap on what else we can do as an industry, as an institution. If that can goes down a little bit, where we can bring in another products which are not qualifying in nature, but at least can diversify our book to make it more less riskier. I think that's something which is very, very needed for the industry. But overall, we understand the the regulator's thought process here, and we are very much aligned to it, because unless we address these two critical issues of over-indebtedness and multiple lending and pricing, these are all three sensitive subjects. We will always be open to risks from political and other sensitive areas.
Okay.
And I think this is a well done, welcome step.
So just one supplementary question. So you think that this 85%, and I'll pose the same question to Ma'am Veena as well, that do you think this 85-15 qualifying and non-qualifying, this will remain? This is not going anywhere. Is that the...
As of now, there is nothing in the guideline to suggest.
Yeah.
I hope it will. We have represented that there should be some headway. But because at the end of the day, with cash and when all that is there, you actually left with very, very little margin to do any new product line or something, which is more, in a more sustainable manner.
But some of the points you have raised, I'll in the next round, I'll definitely pose to Veena ma'am. But with that, I'll now move to Bhaskar Babu. These are interesting thoughts. So the industry has got what it wants, but it wants more. Is the sum and substance of what Dibichathy has said, that now they would like that the regulator listens to what they have. In some senses, the industry has created what is today out there. I mean, of course, now banks have become bigger players and all of that. But there is a lot of work that microfinance institutions have done to get to where they are. And with that, I'll move to Mr. Bhaskar Babu from Suryodaya Small Finance Bank. Same question. What do you really see is going to be, how the guidelines are going to play out for the small finance banks? Do you think that it'll, as Manish said, I mean, he's talking about transparency, that the client will be happy, we are happier because the client is happy and so on. So do you really see that the small finance banks are also aligned with this thinking? How do you think the SFBs are going to respond to what is the proposed set of guidelines as of now? So over to you.
Thanks for moderating this session, and thanks to Access for organizing. And pleasure to be with the next panel. Manoj, I think if you really go back to what happened post-Andhra crisis, all of us as NBFCs, that time there were no NBFC MFIs in the microfinance sector, wanted to be regulated very, very kind of to the dot. So we said we have this as a perception. So we felt that the biggest shield that we will get is tight regulations. And regulator at that point of time, kind of we use the word light touch regulation, as you rightly alluded. Hardly 1% of the banking portfolio doesn't really kind of require so much of a regulation. So what has really happened there and what is happening now is that the impact in terms of the number of households that microfinance touched then in 2011, when the size was 20,000 crores, to what you're talking about is 10 times in 10 years, probably kind of around 15% of the households. The impact or the size of the customer base you're catering to is simply very large. Still, I think it constitutes only 2% of the overall lending portfolio of the country, but still kind of has an impact of 15. So we wanted higher touch regulation. We wanted interest rate to be regulated to a point. In fact, the recommendation we made was, irrespective of the interest rate, capped at 24. Actually, we're all operating at 15% operating expenses, 12%. Sub 5, sub 6 was not thinkable at all. So we kind of did, but the whole metamorphosis of happening, turning profitable with all the regulation, did not even cross one calendar year, probably not even one fiscal year. So it was very, very good for the sector. It played out. 10 years is too long a period of time. So many things have really happened. And at that point of time, 90% of the lending to the sector was from NBFCs, which were operating in this, which became NBFC MFIs. Then all of us kind of, some of us became SFBs. The bigger banks started really operating in this segment as well. But irrespective of the regulations coming in formally at this point of time, voluntarily, the code of conduct now is being adhered to all the players in the segment broadly. What the regulator is now doing is really giving credibility that it is going to be entity agnostic, it's going to be sector. I believe with one stroke of change, which is in terms of defining indebtedness as debt service coverage ratio, or FOIR, which is how it is used across. Only here in this segment, as I said, 10 years back, we just needed a quick kind of a solution, and the solution was in terms of defining by the total outstanding amount of borrowing, which was 1,60,000, 1 lakh kind of got changed. In my personal view, I think this defining, except for the fact that whether it has to be urban, rural, separately defined or one income better at the household level, 8,000 rupees or 5,000 rupees is a monthly obligation. Tells the players, do not treat the microfinance customers as absolute novices into the financial inclusion space. They are also graduating. They have graduated in the 10 years. Why are we really stuck with 1-year loans and 2-year loans and wanting to churn it so fast? Though if you know the customer for 5 years, why are you not thinking about giving her a loan of 3 years? Why not 4 years? This 8,000 and 5,000 actually means we can give a 3 lakh to an urban customer and 1.75 lakh to a rural customer. Whereas the current outstanding per household in terms of the households they cater into is not more than 70,000. That's a large space. I don't think really we need anything more than this as long as we follow all the players in letter and spirit of what is really required for customer protection. And as Munish rightly said, and Vinam also alluded to, is that if the customer at the core does well, we all will do well. Otherwise, temporarily we'll do pretty well, great bumper years of 1-2 years. I think microfinance sector, as was 10 years back, as is today, is poised to grow 15% customer-wise yearly, probably 30% portfolio-wise yearly. But a few of us want to do at 100% growth is what has always triggered accidents. In a road, the accident happens by not what 95%, 99% will be safe. The 2% really starts creating accident. This, I think, clearly defines. I think now it goes into implementation. I think one stroke, you don't need to have complicated regulations. Now we are saying that, no, hey, you decide what your pricing is, but be transparent. Probably one I would really think at southern level, at MFIN or probably at a regulator level, one dashboard, you want to charge 28, you want to charge 32, please publish it there. I would never like to be seen operating at a high rate than NBFC MFI or among SFBs or even among banks. If that transparency of disclosure is put, then it's good that you charge what it is as per your board policy. Automatically, I think initially, while it looked like all of us will increase the rates to cover the credit losses which has happened, NBFC MFI is included. I think at the medium term to long term, the good paying customers are going to get at a pricing which will be substantially lower than what it is today. The one probably add that we can I would rather look forward is that digital inclusion has to really come in here, saying that if a customer wants to pre-close a high-price loan, let there be an option compulsory to be given by all microfinance players. She can just pay through a UPI, put number at UPI, and her loan is pre-closed. So somebody else can really come in and do it at a lower pricing. I think most of our customer households, without us realizing, have become digitally included. Not the lady of the household who's a borrower, but her son, her daughter, we see it in the UPI transactions which are happening. I think put together simple regulations, high level of transparency, or add a layer of digital inclusion because they are changing. They will change much faster. I think we are out there to create what will be a truly financial inclusion field in years to come. That's my take.
Very interesting. So the whole narrative, the whole discourse is moving towards transparency, greater digital play. Of course, I heard about products and the need to innovate on products and why should we be boxed into 1 year, 2 year. I think we heard the same thing from Dipajyoti as well, that why not give us a little more leeway in terms of product and designing new and better products for the client. And I think that is definitely something the central bank should look at. Before I move to Ms. Veena Srivastav, Bhaskar, I'll come to you with another question which has come from the audience. So I'll just read it out for you. That how can the credit bureau information generated by microfinance players, including SFBs, be leveraged for moving into lending in small and micro segment for women? And the supplementary question is also, are there several players who are not part of the credit bureau regime? So would you care to answer it? I'll then move on with the.
I think broadly, everybody has become part of the credit bureau. The submissions have become weekly. I think without anybody realizing, the MFIN and Southern have moved the needle big time. So monthly submissions from generally what used to be, or even continues to be in the general sector, being submitted on 7th or 10th, getting reflected next month 15th. So here it has gone into really weekly. And the credit bureau is so full of rich of data today that if there are certain regulations put, without any of us getting even self-audited, the bureaus authorized by us or authorized by the regulator can give the entire behavioral pattern of not just the customers, of even the players in the financial inclusion space. So that I think is really, really available on a technology basis. I think all of us are participating. I think microfinance as of now continues to be the only segment where the names of the lenders is also known to the other lending entity. That came in basically because if somebody is not really towing the line, well, the SROs wanted to know who that entities are. So I know whether DJ Annapurna is lending to the customer 30,000 or Divya will know whether Suryodaya is lending 70,000 to the same customer, breaking the regulations at that point of time. I think that's kind of been in place for long. I think we'll have to kind of utilize it much more effectively. What the data will now mean is that with so much of flexibility available, with the customers with established track record will start kind of having access, and they are going digital. So I think that's one big recognition we'll have to start doing, that they are going digital, give them the tool that borrowing of 5,000 rupees will become the same cost as borrowing of 50,000, or for us from an operating cost point of view. So I think what you're likely to see with all this happening is that the small ticket loans will be kind of accessed as faster, as kind of convenient, as profitable as mid-sized loans or large-sized loans. I think that's what we are kind of poised to see at this point of time. That's my view.
Okay, that's no, that is definitely the issue. I think, as I said earlier, we sitting on tons of data, including of course the credit bureaus, and I think we'll finally see that data getting utilized the way it should be. So with that, I'll turn to Veena ma'am again, and to put that very famous line made even more famous by the Kargil war. I think the central bank has, ma'am, taken us to a point where that dil mange more is the catchword, because now everybody wants that, and this brings me back to the point that that Dibya Jyoti also raised, and which is also my second question, which is a lot of areas are getting standardized, and everybody is happy that okay, now we are on the same field. The Reserve Bank has started looking at not sort of regulating a methodology or a segment of lenders, but the entire universe of lenders, and I think that's a big step forward. But how about this whole sort of regulatory, let us say, arbitrage? I wouldn't call it regulatory arbitrage, but some loose elements that might still be there in terms of definition of customers, urban, rural, specifying business types, definition of the household income calculations, and so on. So over time, do we look at more guidelines flowing from the regulator, clarifying these issues as the sector again moves to greater levels of maturity, or we'll see that Dibya Jyoti and the entire Sadhan MFIN teams are already coming with thoughts for the Reserve Bank on how these could be done for the sector. So over to you, ma'am. Would like to love to hear your thoughts.
Yeah. Thank you, thank you, Manish. Thank you, Manoj. Basically, we are very conscious of these aspects, because when we came out with the document, there was a good number of feedback. Of course, there are a lot of questions of these types were part of those feedback, and as well suggestions on that. So and basically it was the reason, since we are thinking about it, that is why we put that as a questionnaire, as a discussion point in our document. So now we have received those feedbacks, and we are basically examining it. And sector is so diverse, as well as the borrowers. So it may not be desirable to standardize everything. I'm not saying some of these can be standardized and some cannot be, but basically standardizing the whole thing will again make it Mr. Dibya Jyoti was saying, give us a space. So that is a segment is asked, means the sector is asking the original players, the MFIs. They are saying, give us the space to innovate, make us to become innovative. And at the same time, you are saying that everything should be standardized. So for us, what we feel, there is a need to take a balanced approach without being too prescriptive. But at the same time, where do we feel that we need to come out with regulation, with standardization, there we are coming out. And fact sheet is one of the example where we are saying that you need to be very transparent, and transparent in a way that it is understood by the borrowers in a very simple term. So that is how I'll say the approach of our approach in this regard. Yeah, thanks.
Okay, thank you. Yeah, I mean, it's you know, what we need to ask for. And I think what I see as a general direction is that while some set of guidelines will come out at the moment, I think the RBI is showing an intent that it will be willing to look at it, and probably look at it not after a gap of a decade, but much more regularly. As more information, more data, more feedback keeps flowing in, they'll be happy to look at which are the other areas that might need regulatory support. And I think that's very important, because even to get to this level of, incidentally, ma'am, a very well formulated set of guidelines. Yeah, a lot of reading, thinking, consultation would have gone in getting to this level of where the guidelines, the draft guidelines or the consultative paper stands as of now. So my compliments to that. Let me get to Divyajyoti, because there is a question from the audience. And I know that Annapurna is doing individual lending, so I'll put it to him that apart from making group lending more competitive and creating a level playing field, how can the framework push service providers to lend to individual enterprises of nano or tiny scale? So over to you, Divyajyoti. Love to hear your thoughts, and then I'll get to Manish.
I think that is the one thing I missed from my opening remark was that this regulation, the guideline which is now framed, are more suitable towards individual lending. Being now you will be underwriting longer tenure loans, and you will do a thorough cash flow analysis. You will try to match the seasonality of the product that you are funding. So it is going towards that direction. I think going forward, all the entities which will like to work in this sector will have to come out with a very strong underwriting processes in order to, with the data available, with digital experience available. I think you have to keep innovating and building that processes to move more towards individual lending. I think that's the direction.
I didn't realize I had a poll result already on my screen, so I was just trying to read that. But even as I do it, I'll go to Manish and try and put the next set of question across to him, which is why is it that microfinance in India specifically boiled down to microcredit? I mean, we kept talking about microfinance, but really we are a microcredit industry. And why is it that despite banks coming into the fray, we did not see a diversification of products? So what is it that inhibits banks from, going for a wider bouquet of products? And we especially worry about the level of savings penetration that we have been able to achieve. Despite SFBs coming into the fray, despite the likes of Bandhan getting a banking license, I don't think we got anywhere close to the sort of savings rate penetration. And despite PMJDY, let me also put that in perspective, we still talk about dormancy rates of upwards of 40% in women-held PMJDY accounts. And this is an estimate, and this is our estimate. But we feel that 35-40% of PMJDY accounts which are held by women may be inactive for want of a product that really serves their purpose. And again, I'll quote a very interesting anecdote. We recently started a pilot in a backward district called Betul in MP. And the idea is that how do you get women to access cooking gas cylinders under the Ujjwala scheme? A cooking gas cylinder typically costs about 900 rupees. There are 3 inhibiting factors. One is behavioral, that the mother-in-law, the father-in-law, the husband says that khana ispe jo banta hai, usme smell nahi aati, wo sondi si khushbu nahi aati. So you don't get the taste and feel of food cooked on cooking gas stoves as compared to the chulas. The other problem is access. Even if the agency supplying gas is 5 kilometers away, it's about carrying a gas cylinder and then bringing it back, because home delivery may not be there. And the third is about getting to that 900 rupees. I can buy wood on a daily basis, coal on a daily basis, but for cooking gas, I need to pay a lumped amount of money. And somewhere the assumption is that women do not have that lumped amount of money, so they're not able to access it. So this pilot was started, and more than 1,000 women have taken a loan of 900 rupees from self-help groups to get a gas cylinder. And now the idea is that can we make it a pan-India program? Can we extend it? So, I mean, it brings us back to the point that Divyajyoti also raised, which is product innovation. But I want to broaden it further to say that how do you get to a larger offering of products? And B, do you really see fintechs and a partnership with fintechs emerging now that the sector is wide open? So would love to hear your thoughts.
Yeah, so Manoj, I'll start at a very broad level. You see, for any diversification of the product set that you offer to a segment of customers, primarily it depends upon a few things. I mean, we are out there to lend to borrowers. We are a bank, and any opportunity that presents itself in terms of diversifying or continuing a relationship with the customer over a longer period of time is a welcome opportunity, as you know. I mean, which if it can be done in a manner which does not lead to bad outcomes downstream. Now, what would prevent such a situation from developing is possibly at a very broad level lack of information about the borrowers, some degree of uncertainty in the environment, some degree of uncertainty in the behaviors of the borrowers, etc., and that kind of keeps you away from indulging in such activity. Now, this particular segment, and then comes the role of fintech. Fintech has to be viewed in the larger context of what's currently going on, and also in the context of what the another report by an RBI committee has come on digital lending players, DLPs, and what role can fintechs play. Now, I think what would, as more and more data becomes available, and I also wanted to pick up on that enterprise lending question that somebody asked. What really is happening with any set of borrowers is that if you are lending to like you give this example of these women in Madhya Pradesh, if you're lending to a segment of customer in a very focused manner, and you are trying to you tick all the variables and you manage those variables very, very closely, then you know that this model is going to work. So and then you kind of try to scale it up. But as you scale it up, some other environmental factors that start playing, and that kind of then the portfolio performance deteriorates from where you originally started. I'll give you an example. We were doing this one pilot with a set of customers, borrowers, small farmers, etc., who are now being led on the back of an enterprise wide initiative, like let's say like an FPO. If the farmers are part of the FPO, there's an anchor, and you go and lend to these borrowers, but you blend it with a lot of information overlay on your credit decision. And if we figured out the same set of customers who otherwise would not possibly lead to right credit outcomes at a later point in time, but when you manage it more closely, look at data more closely, look at their behavior, tend to tie it out from all sides, etc., work in some kind of an ecosystem, the relationship management on the ground is very good, proper regular relationship calls are being made, and more importantly, all those stuff is actually being captured into some platform or data, then that it becomes far more amenable to developing new products or platforms to lend to these customers. So what I think, to my mind is likely to, is in the direction it is taking, is that as more and more data becomes available, as some degree of certainty comes into the likely credit outcomes, in terms of overall indebtedness being capped at the household level, etc., and some of the other stuff that we are trying to do through the set of regulations that are being envisaged just now, I think it will lead to more innovation, has to lead to more innovation on the product side, because these customers are indeed graduating from one level to another, and over a period of time, these will continue to go to next level and the next level, and more such opportunities will continue to come. Indeed, we are looking at doing some nano enterprises kind of loans in Bharat Bank, because Bharat is all about these kind of customers. So we are indeed trying to construct some programs which would lend to nano enterprises or small enterprises, which are pretty much individual led initiatives. They're not companies or firms. They're one guy trying to do some small thing. Like I met this women in Kanchipuram. The ladies are just buying silk and getting orders from the local makers of saris, and this lady is making one sari every 15 days and she's earning some money out of it. But she needs money to buy the silk. And then from one level of machinery, she needs to go to the next level of machinery, which can possibly make the silk sari with a faster speed, etc. Now that I would call an enterprise. That's not a microfinance loan. That's in a traditional sense, that is a micro enterprise loan, because she's now engaging in an enterprise too. And then she makes one machine with 2 saris, and then she makes 4 machines with 4 saris, etc. And that's how you kind of graduate. I think information and data capture is more information data as it becomes available makes it far more easier for the banks and institutions to construct such products. Even the information capture on every call as the borrowers are met by your field sales teams, etc. In as much as fintech is concerned, I think there's a lot of opportunity in diversifying and deepening the reach through the fintech ecosystem, which can then plug into the banks or the institutions system. We already there's such models are available in the market. A lot of fintechs are reaching deeply. They're building some data models. There's some degree of innovation that they can do outside of the regulatory framework, since they're not NBFCs or not or entities just now, I think. But they need to also be brought somewhat into the regulatory framework, because you don't want the customers to be misled, or and the right kind of proposition need to be constructed. So in as much as we are concerned, we are looking at fintechs also as a medium to reach out to deeper markets, and within the overall ambit of regulations, I think there's an opportunity there to make that also work. So, and that will also afford you the flexibility of constructing a bit more number of other programs, which can also then be linked to some end users, which you can monitor, especially in the context of Bharat. So, and that's my broad view.
Okay, thank you. And actually, nano enterprise, micro enterprise lending is also one of the faster growing portfolios that Annapurna has. So they have done quite a fair bit of work. It's a very good performing portfolio. Excellent work that Annapurna and Dipjyoti's team are doing in this field. So I know that there is lots of demand for this. With that, I'm getting reminders to sort of close the session. I'll do that with one more anecdote. And largely when microfinance started, and SIDBI was the only sort of lender that was supporting the microfinance portfolio of what was NGOs largely then. One of the schemes that went to the board for approval was that we will lend to MFIs without any collateral. So because one of the from the bank side, one of the views was that at least the NGO promoters should give personal guarantees. And the department managing it, which was known as the Promotion and Development Department, was tooth and nail up against it. No, we will not take any guarantee. There's been no security. It will be a clean loan. So as a compromise, it was worked out that we will take 10% of the loan amount as a fixed deposit, and it will be deposited with SIDBI. So that is how FLDG started in the good old days. But these were NGOs. They didn't have that sort of money. So what they did was they started collecting 10% from the borrowers, saying loan chahiye to 10% de do, hum SIDBI ko denge, and then we get the money and we release it to you. So in some senses, a sort of a deposit mechanism started, and of course RBI plugged it much earlier than the Andhra crisis. So as soon as the sector was getting formalized, RBI came out with a circular saying that ये सब नहीं चलेगा, all this will not be allowed. And it's a very important differentiation, because if you look at the Indian market, we are one of the few markets that don't allow client deposits to be taken in any shape or form. Call it FLDG, call it whatever. It's a clean loan that is made. Otherwise, you look at markets. If I look at a comparable market to India, where cost of funds are somewhat similar to India, it will be Philippines. What is the cost of borrowing? The cost of borrowing for a first cycle loan client can be as high as 85%. What is a typical loan amount that will be kept as deposit by institutions in Bangladesh and Philippines? It can be as high as 30 to 50%. So I take money from the client at 30 to 50% of that loan is actually the client's money, which is coming at 3-4%. And then I am lending at obnoxious rates of 50, 60, 70, 80%. So to be fair to the Reserve Bank, the Central Bank, and to be fair to our own institutions, the way microfinance has been conducted in this country, that we have not ever gone to those levels. In Philippines, one of the very memorable comments that I heard from a borrower, actually a male client, was that these people fry us in our own oil, saying that basically our own money is given to us at the rate of interest, which is upwards of 50% in the Philippines. So with that anecdote and with the excellent start, I would just say that the results of the first poll have just come in, which is to say that we asked the audience whether do you think that the microfinance sector would see growth with the proposed set of guidelines, and overwhelming 66.7% have said yes. 16.67% has said somewhat, and 16.67% has said do not know. There are no no's in this. So I think with that very heartening sort of feedback, we can now close this session. I'd like to once again, on behalf of Access IFI, thank the panelists for their time, and thank the audience for staying with us, which I hope was an interesting and informative session. Thank you so much.
Yeah, thank you, Manoj, and thank you all the organizers and the panel.
Thank you, Manoj. Thank you, everybody.
Thank you.
Thank you,
Thank
Manoj.
you so much,
Thank you.
panelists, for being here and being a part of this really interesting discussion. A special thank you to Manoj Sharma for his effective moderation of the panel. And there were a lot of questions that came during these panel and this session. So it was very interesting for the audience, and they took a huge part in replying to the poll questions as well. So thank you so much for a very insightful discussion. For everybody who has joined us online, they can switch to Hall B for a plenary session happening, a fireside chat on financial inclusion, breaking new ground. In Hall B, it will be Dinesh Kumar Khara, Chairperson, SBI, and Tamal Bandhopadhyay, Consulting Editor, Business Standard. So if anybody who's interested, please switch to Hall B and be part of the session. Thank you so much, panelists,
Thank you,
and
Anusha.
moderator for being here.
Thank you.